Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by BMO's Anthony Willis. Hi.
Hi.
So what is concerning you the most at the moment?
At the moment, I think it's really global growth that's giving us the most concerns. We've gone into this year really with the sort of data showing that things are starting to slow down, particularly in Europe, but elsewhere as well, Asian markets, particularly China. We've seen Chinese growth starting to roll over. The authorities there are doing something about it, but they probably need to do a lot more elsewhere. You look at the US, it's really been very strong last year, but was that just because of the tax cut? This year we are starting to see the data roll over. So global growth is our biggest concern, and obviously that feeds into corporate profits.
And what then, because you're lucky enough to have the world as your oyster in terms of where you can invest across asset classes, across the globe, what are you avoiding in order not to be hit by that slow and growing growth?
Well, I think we're just being conscious of certain areas where growth has really slowed more aggressively. So Europe's the best example of that. You've still got a central bank which is relatively loose, but compared to what the Fed is doing and maybe what the Bank of England is doing, maybe not a little bit more policy constrained than we're seeing elsewhere. So for the moment, we think Europe's probably less attractive. On top of that, ignore the economics, you've still got political risks as well. So we don't particularly like Europe. The other place, of course, is the UK at the moment, but that's more of a political risk concern than a growth concern. We think if we do get some certainty over the Brexit word, we will then see some sort of rebound in the UK growth. It feels like we've been sort of a bit pushed down by a spring at the moment, but we get some certainty on Brexit, that's a positive thing. So we're avoiding or certainly underweight the UK and Europe for the moment. Looking a bit further afield, we still think there's opportunities in Asia and the emerging markets, and that's our preferred areas. The US, we've really been underweight for a little while, just thinking it's too expensive. Unfortunately, it's been too expensive for quite a long time, so we haven't really, that hasn't played out too well for us really relative to some other parts of the world. Thankfully, it's been offset by decent growth, particularly in the second half of last year in the emerging markets.
And what about asset classes? Does either equities or bonds lend themselves better to either avoiding that growth risk or indeed taking advantage where there is it in emerging markets, for example?
Well, I think emerging markets is a good place to start because emerging market debt had a really interesting year last year, a year of two halves, all about the dollar really. So the first half of the year, dollar rising, emerging market debt had a really tough time. Second half of the year, really with the dollar easing off, emerging market debt did pretty well. And so we've actually had a fair old bit in emerging market debt in the second half of last year. As we've gone into this year, we've actually taken some profits there just because we think it's run very far. The dollar rally may well have paused, but there's a fair chance it'll come back just because the US is better placed than a lot of other places in the world for economic growth to continue. So we do feel that the dollar may actually have a little bit more strength in it than some people think. Everyone's been talking about the end of the dollar rally, but other central banks will ease too. Therefore, just because the Fed has eased doesn't mean others won't do the same.
And what about equity opportunities? You've mentioned debt there.
Yeah, so equities, we are actually now underweight equities, which is the first time we've been underweight equities probably for, well, at least 2 years, I'd say. Again, it's those global growth concerns. It feels like earnings growth has been so strong over the last 2 years. It feels like that's coming off now. And we're actually a little bit more interested in fixed income on the opposite side of that, but we're still marginally underweight fixed income as well. So there's a bit of a gap at the moment, and that's where absolute return and actually a little bit of cash comes into play. So our overall outlook is probably more bearish than we've been for a while, but we're not actually taking that much money out yet, but we do see some dark clouds on the horizon.
Anthony, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.